Hey, hello everybody. Welcome to today's ADIT Cyprus Network Webinar. We're obviously delighted to be bringing another webinar in this series to you today, wherever you are in Cyprus or beyond. I'd first like to introduce our ADIT champion for Cyprus, Katia Papanikolaou. So over to you, Katia.
Thank you, Rory. Hello, everyone. We'd like to welcome you to today's webinar. That is the second in a series of webinars to take place for the ADIT Cyprus community. The ADIT network continues to grow by supporting ADIT students and affiliates, making the ADIT qualification a global certification amongst the tax professions. I would like to introduce you to today's speaker, an ADIT affiliate himself, Christos Theophilou. Christos is a partner at Taxand Cyprus and in charge of international tax and transfer pricing. He has a long experience in international corporate issues, and he's a contributor to a number of international tax publications, and also a freelance lecturer on transfer pricing and ADIT paper 1. Christos, thank you again for making this presentation today. In today's presentation, Christos will be exploring transfer pricing risk in the disallowing of intra-group services, and he will discuss the 4-step analysis for pricing intra-group services and what it means for M&E groups and tax administrators. We'll now let Rory to continue with the logistics for the presentation. Enjoy your presentation. Thank you very much again for attending. Thank you.
Thank you very much, Katia. Yes, just a very short amount of housekeeping today. So if you have any questions for Christos during the course of the presentation, I'm hoping we'll get a few questions that we can do in a Q&A at the end of the session. We will hold back the questions and deliver them to Christos at the end so that they're all together there. But if you do have any questions, and we hope you will, feel free to put those in via the Q&A function in the Zoom box. You can do that at any time, and then, as I say, we'll collate the questions and deliver them to Christos at the end. And the only other matter, if you've not yet joined our ADIT Cyprus LinkedIn group, please make sure you do so whenever you're next on LinkedIn. It's a great way of finding out about events like this and other important ADIT and international tax news that's specific to our growing community in Cyprus. So without further ado, I'll hand over to Christos. Thank you.
Thank you, Rory, and thank you, Katia, for providing me this opportunity to provide this webinar for the ADIT candidates. And not only, anyone can participate on this webinar. Let me share my screen. So, my name is Christos Theophilou. I believe that now you are viewing the first slide on a full mode. If not, just let me know, guys. As I previously said, I'm Christos Theophilou. I'm one of the tax partners and transfer pricing in Taxand Cyprus. Taxand is the biggest independent tax network in the world. And we are here today to present you how transfer pricing and intra-group services are implemented in practice. And the topic today is on recognition of the transaction. And this is how I will do it. This is the agenda for today. What is an intra-group service? And we are going to focus on step 1. We're going to see about step 1, and then you are going to see some references that I have provided for you for any further study. Now, let me begin for explaining what is an intra-group service. This is very important. What is the definition of an intra-group service? First of all, intra-group services are found in Chapter 7 of the OECD Transfer Pricing Guidelines. There is a specific chapter for intra-group services. However, what I would like to mention here is that these are the special consideration for intra-group services. So when we apply in practice the intra-group services, we also look at Chapter 1, Chapter 2, and Chapter 3 of the Transfer Pricing Guidelines in relation to intra-group services, and also we also apply Chapter 7 that is specifically referred to intra-group services. Let me say that the definition of intra-group services is very wide. It includes almost everything. So any arrangement between the group, it will be considered an intra-group service. And let me say that because the practical issue of this definition is very wide, all groups have intra-group services. And I will say that from our experience, tax authorities around the globe, usually they begin their tax audits from intra-group service because there is always an intra-group service. And you need to get your intra-group services right, I will say, for the main reason is that since they begin from intra-group services, getting them wrong will not be, I would say, a very good impression. So from the wide definition, I will say that intra-group services are critical. Any group will more likely have intra-group services. Now, in practice, there are two types of intra-group services. The first type is called managerial or administrative services. These kind of services are, of course, chargeable. You will see them in the profit and loss. Usually, the multinationals charge this service. And of course, there are some times that these intra-group services are not chargeable, and we're going to see which services are not chargeable down the road. Typically, in practice, these services are called low value-adding services, and usually they are remunerated with the low value-adding services of 5% on a cost-plus basis. Now, the other side of the coin, we have services that are in the core of the business of the company, which usually these type of services has to do with the revenue and the main lines of business of the company. These kind of services are typically, a few examples just for you to understand, is R&D services, distribution, sales, and marketing. So for example, you can split the two types of services as back office and front office, or as managerial administrative service, or services for in the core business of the company. Now, these services are typically called non-low value-adding services or high value-adding services. This is how you see them in practice. So at the end of the day, a group might have either of the two types of intra-group services. Now, it is very important to understand also what is not an intra-group service. So what is outside of the scope of these intra-group services? Let me begin with that cost contribution arrangements, which are actually services fall outside the scope of Chapter 7, but they fall in the scope of Chapter 8 of the OECD Transfer Pricing Guidelines. Also, apart from cost contribution arrangements, there are also two types of contracts. The contracts that we see in practice, which is the intra-group services contracts, and also there are sometimes contracts that they include not just intra-group services, but we call them in practice mixed contracts. So you may have a contract that it has one component, which is your intra-group service, and another component will be sale of goods or licensing of an intangible. So in this type of contracts, we need to split the component which is intra-group services, and the other part will not be an intra-group service. It will fall in any other chapter, for example, Chapter 6 of intangibles. Let me give you an example. You may have a know-how contract, for example, a company that license, maybe it's McDonald's, you license your IP to your licensee, to your subsidiary, and there is a component of a royalty income on that licensing agreement, but also on that agreement, there is a component that says that the head office of McDonald's will provide services like training, consulting, know-how, and so on. That part is not a royalty income, that part is license income, So one party is license, other party is services. So you need to split the two and price them accordingly. Now, let's move on in practice now that we set up the scene. When we are providing transfer pricing documentation, we typically follow a 4-step approach for all types of transfer pricing documentation. The first step is the identification of commercial or financial relations. The second step is recognition of the controlled transaction. The third step is the selection of the most appropriate transfer pricing method. And the fourth step is the application of the selected transfer pricing method, so-called economic analysis or benchmarking. Now, when it comes to transfer pricing, usually we follow a 2-step approach, and this 2-step approach usually converts this step 1 and step 2. Here, this is the first step, and then you go to follow another step, which is step 3 and step 4. If I may go back, sorry. And step 3 and step 4, here we consider them as another step. So if I move forward, this step 2 process, the first question when it comes to intra-group services is that whether a service has been rendered. And this step here is effectively the step 1 and step 2 that we have seen previously. And if the answer here is yes, we move on to the next step. Let me say at this point that whether a service has been rendered, we see this from the service provider and the service recipient. So we consider this from both perspectives in order to confirm that the service has been rendered. This test is the so-called benefit test. And this is the main issue that we're going to consider today. Our presentation mainly focuses on the benefit test. If you pass the benefit test, then, and the answer is yes, then you move on to the next question, which is, what is the arm's length charge of this transaction? And what is the arm's length charge? We follow the transfer pricing methodologies to price the transaction and effectively see what is the price of the controlled transaction. So today we are going to focus on this step here. And maybe this is a suggestion to Rory and Katia, maybe another webinar will follow to consider the second step on pricing intra-group services. Now, let's go and see the details, how we see the intra-group services in practice and whether they're actually pricing intra-group services and whether they are recognized in practice. Now, pricing intra-group services, effectively, we need to answer the so-called the benefit test. If you pass the benefit test, then it means that your services is chargeable. How we do that? We are going to perform the willingness to pay and perform for itself test. And what is this test? We start from the first question saying whether a service has been rendered. If a service has been rendered, then we consider whether we look at effectively the service recipient and whether the service recipient is conferring an economic or commercial value to the services received. So I received a service, I am the service recipient. Did I receive an economic or commercial benefit? If the answer to this test is yes, then I move on to the next question. We need to find evidence of this value, okay? And when we trying to find evidence in practice, what we look at is we do the so-called willing to pay or perform for itself test. We look at the service recipient, and the service recipient will effectively say, would this service recipient be willing to pay for this service, buying it from an independent party, or it was willing to perform for itself this service. For example, if I am outsourcing my accounting or doing it in-house, it means that I will have been willing to do my accounting in-house for me, for itself. And how we do this, I mean, how we pass this willing to pay or perform for yourself test, we look to find and identify need of the group. So there should be a need, and this need needs to be satisfied. So if we find this need and the need is satisfied, and at the same time the service recipient was willing to pay for this service, or it was willing to performing in-house for itself, this intra-group service is effectively chargeable. So what does this mean, chargeable? Let me give you a practical example. A chargeable service here will be that if the service is not chargeable, then it means that the service will be derecognized. So let me give you a practical example here. Imagine that you have a company located in a low tax jurisdiction. Let's say this low tax is the BVI. Don't have anything to do with BVI, but I'm choosing a BVI, and it provides a service to a company, let's say, in a jurisdiction like Cyprus, and it's providing a service. This service has all the contracts, so this is a service. I have a contract in place, so I have a contract. Okay, I also issue invoices. Okay, and this Cyprus company is paying me back for this service, and this is a bank payment. So this is a payment from a bank. Say this is 1 million. Now, if this company does not pass the benefit test, so the benefit test will be that has a service being rendered from the perspective of the BVI company. So there are actual people here performing this service. And then you look at the service recipient, which is the Cyprus company that passes the benefit test. If not, it means that this expense here, the 1 million, so this is an expense in the book of the Cyprus company, will be disallowed. So 1 million are disallowed, and then this means that the Cyprus company taxable income will be increased by 1 million. So this is important for recognizing intra-group services, because if they don't pass the benefit test, tax authorities will disallow the expense, and this means that your income will be increased. Now, let me give you some practical examples here. Is that the transfer pricing guidelines include specific examples for non-chargeable services. These are the shareholder activities, duplicate activities, the incidental benefit, which is based on the activity test, the incidental benefit, but here in this situation, there is no overt action, the so-called passive association or implicit support. The incidental benefit that has to do with group synergies. And again, there is no deliberate concentrated action within the group. Some on-call services that the need for providing this service is remote. And finally, there is an exemption that if the service is chargeable, but the costs are pass-through costs, then it means that the service is chargeable with no markup because the pass-through costs are not chargeable. So this is your guiding slide for all the non-chargeable intra-group services mentioned from the transfer pricing guidelines. I'm summarizing them here and I'm giving you them in plate. So let me go through and see one by one. Let me dive into the details. Now, shareholder activities examples. In the guidelines, they say that shareholder activities are non-chargeable, so you need to disallow them. And these activities, they have to do with the parent company. So parent company is organized a meeting of the shareholders. There are some costs. These services are not chargeable and are disallowed. Likewise, if the parent company is doing their consolidation report and there is a cost there, you don't charge the service within the group. Even if you charge them, you need to disallow them. Another example is raising of funds for the acquisition, compliance for the parent company, relevant tax laws, and also some corporate governance and so forth. Now, shareholder activities in practice are very, very important, guys. I would say maybe it's the most important one. And the issue is that these shareholders activities, despite from the specific examples that the OECD Transfer Pricing Guidelines include, in practice, we see a lot of mixed activities that we need to separate them from shareholders activities and chargeable activities. Now, these activities are usually stewardship activities. So stewardship activities, they are similar to shareholder activities, and in practice, they meet the benefit test. So they should be distinguished from shareholder activities, and these kind of activities are chargeable. Another area that the rules are not clear is fundraising activities. As we mentioned before, some fundraising activities are not chargeable, but there is an area, for example, that if the parent company is trying to assist the subsidiary to raise funds, and there is a cost there, that cost will normally be considered as chargeable, and you need to charge this service. Likewise, the cost of managerial and control and monetary activities that is found in the 1984 report, usually they pass the benefit test, and therefore such activities are chargeable in practice and not disallowed. Now, one of the most complicated, I will say, example in practice are management fees. Management fees, they don't have a definition actually. Everything falls under management fees, and the issue that we see in practice is that tax authorities usually put management fees on the spot, on the eye. They are always checking management fees because management fees is like sundry expenses. You dump there whatever you have, and you don't know whether this is chargeable or not. So I will say management fees is a red flag, and you need to consider whether the management fees are chargeable or not. Now, if you want more practical examples, you can look at the guidance of the EU Joint Transfer Pricing Forum, Annex 2, and the guidance included in the UN Practical Manual on Transfer Pricing. I have the links at the reference at the end of this presentation. Now, let me move on to another activity that is not chargeable, the so-called duplicate activities. The general rule is that no duplicate activity is chargeable for the simple reason because no company is willing to pay for a service twice. All commercial companies, they are set up for doing profits, and because they are set up for doing profits, commercially it doesn't make sense to pay for the same fees twice. Now, however, the OECD Transfer Pricing Guidelines, they provide two exceptions. The first exception is temporary activities such as reorganization to centralize its management function. This type of activity is considered duplicate, and it might be considered chargeable. Also, to reduce your risk of wrongdoing business, for example, you have a big dispute litigation, and your advisor says A, you don't believe him, you think that the risk is very high, and you want to take a second legal opinion, you go to another lawyer, and the other lawyer provides you a different opinion. Such type of services are chargeable within the group. Now, it's very important to say that you need to look each case by case individually. Every case is different, and you need to take into consideration that not all cases are the same. Now, let me move on to incidental benefits. And moving to incidental benefits, the first incidental benefit will be a benefit that has to do with an activity. So this is called activity-based. This kind of benefits is that one member of the group is doing an activity and unintentionally provides a benefit, a spillover effect to another group member. These type of activities are not chargeable and are exempt from transfer pricing. Now, examples will be are part of a reorganization or a restructuring. So maybe the group is restructured within the region of the EU. US multinational is restructuring their EU activities. And because they are restructuring their EU activities, maybe the companies that in the region of Africa, let's say Egypt, they get a spillover effect because their business is increasing in the Eastern Mediterranean area. So these type of activities will be, there is an activity there is the organization. However, the spillover effect is not chargeable because the Egyptian subsidiary was not willing to pay or perform in-house for itself this service. Now, another example found in the guidelines is using group names. For example, when you get your company name, your group name, for example, like we are using the Taxand network, and we get a spillover effect by using this name. It means that this spillover effect that we are using this name is not a chargeable service within the group. Now, let me move on to incidental benefit where there is no overt action. So this is a so-called passive association or implicit support. Here you get a benefit just being part of the group, but you don't do anything, but you just get this benefit as because you are part of the group. So for example, you are a subsidiary in Greece and you go to the bank, and because you go to the bank in Greece, you get a better credit rating from the bank. So you get a loan that this loan is with better terms because you are part of the group. For example, let's say you are McDonald's, and because the bank in Greece considers that because you are McDonald's, you're not going to default. And for this reason, they give you a higher credit rating with better terms. This passive association benefit is not chargeable, and it is also included in the Chapter X guidelines that says that you should not charge this type of guarantee fees. Now, if, however, there is an overt action, an explicit guarantee issued by the parent company, so for example, McDonald's head office, they provide an explicit guarantee to the subsidiary in Greece, and therefore you get a better credit rating and better terms. It means that this activity is chargeable and you need to charge it accordingly, according to Chapter X. So it's very important to see whether there are an explicit guarantee or an implicit guarantee for the passive association. Now, another example for incidental benefit is when it comes to group synergies. Here in practice, we all know that the groups, they are centralized their activities for achieving synergies and economies of scale. This is very important. And whether there is a deliberate concentrated action resulting to a synergistic benefit, then you need to price this. If not, then you don't price this. So for example, you are an M&E and you buy widgets for different suppliers in different countries, and you say that, okay, I will set up a subsidiary centrally to make the procurement and renegotiate the prices to get volume discounts. It means that this is a deliberate concentrated action from the group to get the volume discounts because you negotiate the prices with the specific suppliers that they are selling widgets, and for this reason, the activity is chargeable. However, if a supplier on its own provides a group member a favorable price because they consider that they will get volume discounts or they consider that they will get more work from that group, it means that this activity is not chargeable and you shouldn't price this activity. It means that such service should be disallowed. Now, let me move on to on-call services. On-call services are effectively services that, for example, you have a retainer with a lawyer or a service with a computer company to instantly provide you 24/7 service for you. And for this reason, because you get priority, you pay a higher amount. On-call services are generally chargeable. However, specific services, on-call services, will not be chargeable. For example, they will not be chargeable when the potential need for the services is remote and the advantage is negligible, or it can be obtained by other sources better. So you are better off. So for example, I am in Taxand Cyprus. We don't need a 24/7 IT guy to provide us services 24/7 because we are not a bank, we don't have ATMs, and our systems doesn't work during the night. So if we have a comparable service agreement with the bank for IT service, I will say this will not be a service that it gives us a better advantage because we don't need it. So the need for such type service over the night is remote, and the advantage that we get when we price our client is negligible because our client doesn't really care because we have a 24/7 IT, high value IT contract, because this is not a service that they will buy for them. They just need our deliverables during the day. So for these reasons, this service will not be chargeable. Now, let me wrap up the examples found in those Transfer Pricing Guidelines about not charging, and this is the pass-through cost when the services are chargeable. So pass-through costs are not chargeable, and what I mean about chargeable, imagine that you have an intra-group service, and this intra-group service, you need to calculate the cost that it will be based for your markup. Now, if this is, let's say, for example, advertising or group members are providing you some services, and in such cases, then there are pass-through costs that are charged between the one company to another. For example, let's say you pay out-of-pocket expenses, or you are making some agency transfer facilitation payments from one company to another. All these costs are not chargeable, and you need to disallow them. Now, another example for non-charging intra-group services are found in the Chapter X guidance on the cost of funds approach that says that if you have, for example, a loan and you received a loan from a third party, and then you provide this loan to a related party, and you are using the cost-plus method to charge this loan. If you incurred any expenses that they are pass-through expenses, you don't charge them, but you charge only the ones that they are actually a cost to incur that service. Now, there is a big question when it comes to financial services. Should we treat them differently? So setting aside from whether this is chargeable or not, sometimes we treat some services differently, and this is when it comes to financial services. So Chapter X overlaps a lot with Chapter 7, which is services. So for example, if you have financial transactions, you might charge them differently. For example, you might charge them on a cost-plus basis or a handling fee approach. So if this is the case, if you are charging on a handling fee approach, I will say that you are charging a percentage on the asset and not on the cost. So it's very important to know that sometimes chargeable intra-group services, they might be charged differently. These type of transactions are typically cash pool arrangements. Let's say, for example, you have a cash pool arrangements, but actually you are not a real cash pool leader, but you are actually providing support service, like in the treasury department. Then this means that you are providing a service, you are not a cash pool, so you fall under Chapter 7, which is services, and not under Chapter X, which is financial transactions. Likewise, when you have the cost of funds and intra-group services approach, Again, you need to be aware that this overlaps with services. So the financial services part, Chapter X will not be applied, and you are going to apply the Chapter 7, which is intra-group services. Now, in this type of activities, which is financial services as loan, hedgings, and so on, you charge the service on a spread based on the asset or in the interest rate of the asset. So, for example, if you are a company that is providing back-to-back loans, instead of pricing your transaction on a cost-plus basis, what is the cost of the company performing the back-to-back, and then you add a markup, you are actually calculating your remuneration based on the spread, which is the margin, as I mentioned before, for example, 20%. Now, before concluding here, I'm summarizing here the overlap between Chapter 7, which is services, with the other chapters in the guidelines. I have given you some examples before, but now I have the summary here for you. This is an extra slide just for you if you want to have a further reading. Now, let me move on to give you a bit of flavor of chargeable services. The chargeable services are usually split into two categories. These services are usually centralized services, or they are on-call services or ad hoc. And these are some examples. For example, maybe I want to centralize my IT, HR, marketing, treasury, accounting, or legal. These type of services are centralized, and they are very important for taxpayers to be chargeable. And this is a very nice topic when you are going to argue on your local file why you should charge these centralized services and why you want to get your deduction properly. This is the reason that we see in practice. There are commercial reasons like the economies of scale. There are also administrative reasons. When you centralize service, you supervise them more efficiently, so you increase your quality control. And also there is also tax optimization, because you might end up paying less taxes around the globe. And if you want more examples, these are some examples found in the guidelines. You can go through and see them in practice. Now, I have some reference here. These are the links. Whatever I mentioned before, you can click here on the slides. I believe that the CIO Rory will circulate the slides after our session. So if you want to go through and see the details of what I mentioned before, you click here on the links and you will find further guidance. And this is more details about myself. I hope you enjoyed the discussion, and I will be happy to pick up any questions that someone might have on our presentation. Thanks a lot.
Thank you, Christos. Thank you for an excellent presentation and for giving us such details and with examples as well, very clear. I have one question, if I can start the Q&A session. You made a list before with the non-chargeable services, an example with non-chargeable. What are your expectations with regards to the tax department challenging one of these services? Which one you expect more to be challenged?
Yes, excellent question, Katia. I will say that the most important one of these, it will be shareholders' activities. Shareholders' activities are mixed activities in practice. So I will say that the big multinationals, usually they get this wrong, because you have all these discussion whether it is a shareholder activity, whether it's not, whether it's a stewardship, whether it's not a stewardship, and so on. So I will say that the shareholders' activities are the ones that we see in practice that tax authorities challenge them. And because usually the taxpayers get it wrong, I will say this is the one thing. And the other thing is that because you need to have a very good system in place. For example, management fees, usually the big multinationals, they dump everything there as management fees, but management fees sometimes they are chargeable, sometimes they are not. So you need to split them, you need to have very good documentation to support of why these services will be chargeable or not. So I will say shareholders activities is the most important one.
Okay, thank you very much. We have a question in the Q&A. Could you please clarify what are the requirements to practice transfer pricing study in Cyprus? And by that, I mean what person can do the transfer pricing activity report, who is considered transfer pricing expert?
Yeah, very nice question. So in Cyprus, we have a threshold for preparing a local file, to have an obligation to prepare a local file. And this threshold is a de minimis threshold of 750,000 of transactions. And when we say transactions, it's a two test, is either your contractual arrangements or your arm length. So if, for example, you have an intra-group service of 500,000, but the arm length of this service is 1 million, it means that you are above the threshold, despite from the fact that you charge less than 750. So it's a twofold test. Now, who is a transfer pricing expert? This is a good question that is undefined of who is a transfer pricing expert, but our local law says that the transfer pricing should be reviewed by a person that has a practice certificate from the Institute of Certified Public Accountants in Cyprus. What I expect, I mean, just to answer the question, that someone is an expert on transfer pricing to prepare a study, I would say a person that has both the credential, I mean, the academic credential of the transfer pricing and also the practical experience to prepare transfer pricing. So you need to have both, I would say, in order to be able to prepare a transfer pricing report. And why I'm saying this is because the transfer pricing guidelines that you need to follow, the 2022 transfer pricing guidelines, are 700 pages long. And if you have a PE in practice, a permanent establishment, if you add there another 200 pages or so from the authorized OECD approach, I will say that you have almost 1,000 pages to apply in practice. So it's not an easy exercise sometimes. It can be an easy, it can be a difficult case, but I will say that this is an area that the person should be an expert to be able, at least on complicated transactions, to prepare a solid report on transfer pricing.
And a last question is, what taxpayers and companies need to have in mind now going forward with regards to meeting first their TP obligations and documentations, and specifically how to secure that they have a solid TP local file? Yeah.
Excellent question as well. So the first part is that first they need to identify their controlled transactions. This is very important. To identify your controlled transaction, then first you need to see whether you are a related party or not for the purpose of transfer pricing. So each country has a different threshold on that. For example, Cyprus uses a 25% relationship test all the way up, directly or indirectly. Other countries, they have higher or lower related party thresholds. So first you need to see whether you are a related party for the purpose of the transfer pricing law. And then you need to consider, as I mentioned before, the 750,000 threshold, whether you are above or below either transactions or the arm length amount. Now, this is maybe looks an easy case in practice, but sometimes it's difficult. For example, imagine that you are a big group and you centralize your activities in Cyprus or in Malta or in Ireland, and you centralize your accounting, but you don't charge for this service. So this will not be spot in the financial statements, but because you don't charge the service, the country of residence of that headquarter company, the service center, as we call it in practice, needs to price and charge all these subsidiaries that you are centralizing your accounting system there. So you understand that you may not have even a transaction, but still you need to price that. Or, for example, you have an interest-free loan, or, for example, you have on your balance sheet an IP asset, a brand name, that this brand name is used across the group via license-free agreement, or even there is no agreement, but no agreement in place, but there is an oral agreement that the subsidiaries are using this name in order to trade, in order to enhance their marketing in that country. So you need to pay a royalty income on that asset. So it's very important to identify their control transactions, either transaction or not, it doesn't really matter, in order to spot them and then price them accordingly. Now, moving to the next one, how to prepare a local file. I will say prepare a local file. It needs to have at least these 4 steps here that I mentioned before. These 4 steps here will give you the comfort that the local file is strong. Any local file need to have these steps. And I will say that the most important steps of this, I mean, all the steps are important, but it's very important for the transfer pricing advisor to understand the group, understand how the group operates, and also include in your local file all the necessary arguments, because at the end of the day, a transfer pricing study is more an art or a science, and you need to have solid arguments in place to convince the tax authorities that your price that you use is arm's length. So a weak documentation will produce weak results, and that weak documentation will be challenging in practice. So if, for example, to give you an example, let's say you have management services and you include everything there, in your documentation, you need to say whether this management service, what exactly is this management service? Is it shareholder activity or is accounting? Or do you allocate them in practice based on the correct volume? So your allocation key that you charge them along the group is correct or wrong? Do you issue proper invoices when you charge them, or you just use one invoice says management fees and that's it? You don't include details. So, I mean, it's very important to have a detailed report, and the detailed report always, it's always a matter of the materiality, how material is the transaction in place in order to have a solid transfer pricing report.
Thank you, Christos. And we must say that due deadlines for the 2022 for Cyprus will be by March 2024, which is the filing date. So therefore, there is not much time left to plan ahead and organize. And I understand also that any penalties on non-compliance and submission of relevant documentations are quite harsh. So this is something that everyone needs to have in mind, being compliant. We have another question in the Q&A. Can an internal transfer pricing team prepare the transfer pricing report and get reviewed by the outsourced transfer pricing expert in order to reduce the cost compared to preparing fully by the outsourced expert?
Yeah. The answer is yes. I mean, in our domestic law, it doesn't say that it's obligatory to done this externally. So the law says that doesn't mention who is obliged to prepare the study. You can do it internally. What it says is that study needs to be localized and reviewed by an expert. And it doesn't say, okay, the law expert, but it says that it has to be reviewed by a person. This is a quality review. By a person that has a practice certificate from the Institute of Certified Public Accountant in Cyprus. So the answer is yes.
And another one, in your experience, have you seen loans from subsidiaries to parent company without being charged, especially when the loans are repaid within a period of few months?
Loans from subsidiaries to parent or any other transaction is an intra-group control transaction that you need to be priced in accordance with Chapter X. So it doesn't really matter whether you gave the loan, let's say in February, and you, repaid the loan in summer. So for example, you gave a loan 20 million in February, and in summer you repaid that. Still, maybe at the year end you don't have a control transaction, you don't have a balance, but during the year you had a transaction that it was above the threshold, and you should have priced that control transaction in accordance with the arm's length principle. Now, because it was repaid, and if I understand the question, Katia, let me know if I got it wrong, that you don't need to prepare a study because you repaid the loan during the year. This is not the case. From the moment that you exceed the threshold, you need to prepare a local file. It doesn't really matter if you repay the loan earlier or, I don't know, a month after or two.
Yes, and if I may add on this, even though there may not be any balance at the balance sheet date shown on the financial statements as outstanding, still during tax examinations, the tax department may request the movement of or detailed ledger. So this is something that may come up during a tax examination.
Yes, correct.
So yes.
And may I also add this, Katia, is that here in Cyprus, we have the so-called summary formation table that you need to include your control transactions. And the responsibility of the preparing and submitting the summary formation table lies on the taxpayer. So the taxpayer is obliged to identify the control transactions and identify and also prepare a local file. So if you prepare your summary formation wrongly, it means that you are liable for wrong preparation, of course, and not preparing the file. Because if you don't spot the control transaction, your summary formation table will be incorrect. And also, I presume you haven't prepared a local file. So you have both problems. And I agree with you, just looking at the transaction at the year end, you have a risk of not completing your summary formation table correctly.
Mm-hmm. So and I hope this is the last question. Do you need to have transfer pricing study for a loan with minimal percentage, i.e. 0.1% from a shareholder to company? And this is one question. And then finance the loan to other subsidiaries. So the question is if there is a minimum percentage from a loan from a shareholder to a company.
As the law stands today, the law says in Cyprus, at least in Cyprus, the law says that you need to price your control transactions in accordance with the OECD Transfer Pricing Guidelines as amended. You may use the OECD Transfer Pricing Guidelines as amended, meaning that you need to price your financial transactions based on Chapter 1, 2, and 3, and also Chapter X. And maybe we can also run another webinar on this. But in the Chapter X, it doesn't say anywhere that there is a minimum margin. You need to price them in accordance with the arm's length principle. And the arm's length principle is, in very brief, what would an independent lender, let's say a bank, will lend you based on the facts and circumstances at the date of the transaction. So there is not a minimum margin. But if, for example, tax authorities would like to publish safe harbor rules on this is a different story. But as the OECD Transfer Pricing Guidelines they stand today, there is no minimum margin.
Okay. Thank you very much, Christos. Thank you for taking the time to present this topic on transfer pricing, which I am sure there will more presentations will follow. Thank you, Rory, for arranging the presentation, and to the CIOT events team. And thank you all for participating in the presentation, which will later be listed in the social media, so everybody can have access to it as well to watch again.
Thank you very much, Katia, and yes, let me echo my thanks as well to Christos for a really well thought through and enlightening presentation. And I certainly, I for one would be delighted to welcome him back for another presentation looking at step 2. We hope that all of our participants have equally enjoyed the session, and yes, we will be following up with the recording of the presentation. And that will be available to view on our social media, and everybody that's signed up will get an email with access to the recording and the presentation as well. So thanks to everybody, and enjoy the rest of the day, and have a good weekend.
Thank you everybody. Bye-bye.
Bye.